Thank you very much for your invitation and for your kind words of introduction, Ms. Flick. It's a great pleasure for me to be here today. And as you said, this is a topic which, like no other topic, deals with the possibility of failure. This applies not only to the financial crisis or to the various financial crises that we've been faced with recently. The crisis in the euro area is now entering its fourth year. And if you take a look further back in the past, then you'll see the finance crisis in the real estate market in the United States is more than 6 years ago now. And in general, you can say things have calmed down. And I assume, however, that this is a bit of a deception. It's illusory because the central banks, including the European Central Bank, have done a lot to calm things down. However, the problems themselves have not really been solved. Considering failure, expecting that it might happen, is not something that results only from the present financial crisis. This is actually a core element in all of our actions and reflections on the financial market. A shareholder that lends capital to a company will think very carefully about which company it wants to provide capital with. Is there a probability that the company might go bankrupt? Or if you buy a bond, you might think carefully about how sure it is that you will get the money back. And the same applies to a whole industry. This is what we've heard about already. Rating agencies, analysts, these are all tasks which are there to try to control the risks and to give recommendations based on the opinions resulting. Now, the basic topic here in financial markets is, well, and this is something that we can say very specifically, it is the interdependence between risk and yield. If you want to enter into more of a risk, then you would expect higher yields. And the other way around, if you want an investor to enter into a more risky type of investment, then of course this should be given a higher risk. So this is quite easy to understand, and it's based on our day-to-day view of things, because financial markets and people involved in the financial markets try to prevent failure. And if there is a failure, then they want the damages to be kept to a minimum. There are some basic principles that the financial markets and the players on the markets, as well as the regulators, have come up with. And these are principles which can help to reduce damage. And the first is that the one who bears the risk is the one who should get the yield as well. But you can put it differently as well. The one who enters into a risk should also get the return. So if you set up a company, the founder has the incentive to get the return from this company. So the possibility of failure is a real catalyst in working very, very hard, being very committed to bring the company forward. But for financial markets, this means that there is a major incentive to diversify. In English, we say, don't put all your eggs in one basket. You should diversify your portfolio so that you will not be surprised if one individual egg fails, if you focused on just the wrong egg. What's interesting here is, and this is the major component of the financial market theory, is that the risk compensation only relates to that part which cannot be limited due to non-diversification. If the sun is shining today and I've put my money only in my umbrella, well, I can compensate for that because I can also go to a manufacturer of umbrellas and parasols, for instance. So what I really will be compensated for is the fact that the purchasing power might not suffice to buy both parasols and umbrellas. And the final point, a very important point here, that has already been touched upon today, is the fact that despite all of this diversification, it's important to have a buffer. So if it doesn't work, you can still minimize the risks. You need a buffer. Donald Rumsfeld summed it up and said, you have to provide for the unknown unknowns, the uncertainties which are out there. And I'll come back to that in just a minute. And this is one area. It's a question of equity requirements at banks. This is a very important point. That's the ideal world. That is the financial market theory that we've had for about 40 years now, and that is dealing with expecting the possibility of failure. But does that still apply today? Do we still live in a world where this risk-return relationship still exists? Or is it possible today that you might achieve return without having to bear the risk? So returns, for example, from investments in banks or government bonds without having to run the risk of a default of these bonds. So it would not really matter if this strategy is seen as positive or negative. You know that your capital will be paid back. But to put it in other terms, do we still have to expect the possibility of failure if we invest in financial markets? What does that mean? If we know, or at least some people know, that it will not be possible for failures to occur in the financial market. If we see this in abstract terms, well, let me give you two examples. The first example is, and this can be seen as a collective strategy, this is what we refer to as the no bailout principle. In other words, no country in the euro area would fail if they are not able to pay back their liabilities. This no bailout principle, if you talk about the risk-return situation, this would mean that since the euro came to be, there have developed major gaps between countries with a high credit rating and those that have a lower credit rating. And you will see that these gaps in the returns were quite low. Why is that the case? Why are the gaps between Germany and Greece, why were they so low? And this is a major explanation for this could be that we've always assumed that there would always be somebody. If there is insolvency in Greece, then somebody would bail Greece out. And then the other question is, what about the prices that you see in these markets? Are these good indicators of what is actually going on? Or are these prices impacted by the states or whatever? So is failure something which ex ante has already been excluded? And what would this mean for your decision in investment terms? The second example would be that failures of investments in banks have declined considerably. And this can be seen by the fact that rating agencies, they take a look at what the probability is of a payback for the bank bond. And there are two things that are included in their decision. One component is how strong is a bank? How easy will it be for the bank to pay back this bond? And the more threatening aspect is that there is another component, and that is how probable is it that the country where the bank is located will be able to pay back the creditors, or to bail them out, in other words. But that means basically that this is a transfer of risks from the private creditors to the state, because private creditors will no longer have to be considering how the strength of the bank is. They can rely on the country, and the country would then bail out the creditor. So that means failure is ruled out in these examples. And it also means that risks are borne by third parties, the taxpayer. So the question is, how, in this crisis, how can we talk about property and risk or property and liability, and how can we come up with rules which will not only apply in individual cases, but in many cases, so that everyone would have a clear-cut expectation from the very beginning when it comes to their investments and their strategy in a financial system. I'd like to take one step back right now. We hear a lot about the fact that there is an excess in state debt, and there is a clear violation of what was agreed before the euro was introduced. Let me give you some examples. At the end of last year, Greece had 157% indebtedness, Italy 127%, Ireland 118%, Portugal 124%, and even Germany, the model, had a state indebtedness rate of 82%, way above what was defined. And this is very interesting for Germany because you can see that this has been increasing continuously from about 20% in 1970 to about 40% at the time of German reunification, and now it's at about 80%. This increase is explained by the fact that the state has been spending more and more money and has taken in more, but has been spending more than it has had in terms of income. And that is why the state indebtedness has gone up and up. Now, that's just one point, but we must not forget one other point, and that brings me back to the question of failure. The state indebtedness is not the only aspect to consider. This, of course, is seen by rating agencies and analysts. It's hard for them to assess it. It's hard for them to predict whether the state or the government bond will be able to be paid back or not, because in the private area, the solvency here will also play a role in calling this into question. So let's try to make this a bit clearer. Take a look at the 3% criteria. No more than 3% of the GDP in a certain year in terms of new indebtedness. And you will find, and I think that this will not surprise many of you, and that between 1999 and 2009, the country that violated this most often was Greece, 9 times. I think the one year that it did not violate this rule could be explained by means of statistics, and not that they really abided by the rule. But it's also interesting to look at the country that came in second, Spain and Ireland, or in Italy, the ones we talk about the most, Germany and France. Spain and Ireland in these 10 years only violated this criteria twice. Spain in 2005 to 2007 actually had a surplus. They were really becoming a model here when it came to state indebtedness. So the question is, how could it be that Spain and Ireland, they were models during this period, and then they entered a situation where they were no longer able to serve their debt? And this is due to the fact that the private indebtedness, which is reflected in the banking center, was seen as a conditional liability for the state. And this conditional liability was then, due to the fact that this could not be cushioned by the private sector, this was then transferred to the state sector, and then in a very short period of time, the burdens that we had in the Spanish sector were also expanded to the state sector, and in Spain and Ireland, we saw that there was a high indebtedness very quickly. This increased very dramatically, and this is something that you see quite frequently when countries become in a situation of major crisis. So this means, or why is the situation as it is? If we talk about the relationship here between private indebtedness, bank indebtedness as a conditional recognition here, we see that states are in a difficult situation because they have to help out their own banks. And now I would like to take a look at this from 2 different areas, and I'd like to talk about diversification once again. Let's go into more detail on that to see that in many levels there was no diversification and there was not a sufficient amount of risk provision. And this is also seen against the backdrop of the fact that failure had not been considered, and they still hoped that somebody would come around and bail them out. And one thing that you read again and again is that banks, and this is not what was expected, but they were not diversified very much at all. They invested in government bonds, for instance. Just let me give you a couple of examples. Banks in Greece, in Spain, in Ireland, in Italy, they often invested many times over their equity in the government bonds from their countries. And we should also say, due to the ECB, they even increased this share. But once the government bonds and the governments had problems, then the banks automatically had a problem as well because they had invested so much of their equity in government bonds. So regulating all of these risks would mean that this would go against diversification. There was no diversification. There was a high degree of concentration of all of the risks in one particular category of investment. And this ran into problems, and this meant that the banks automatically suffered as well. So the causal relationship is clear. And this is due to the fact that high risks for the states were then impacting the banks, which made the banks brought them to a difficult situation as well. And this is not only from the state sector. There are also other examples which are related to the fact that diversification was not implemented as one would have expected. For example, they invested in American subprime products, that investments were made in real estate markets in the periphery of the Eurozone. And just let me give you one example. The Saxonia State Bank 6 years ago is one of the first two banks that suffered. Nearly 900% of its equity was invested in corporate bonds or in state bonds from the United States. So if they lose 1/9 of their value, then all of the equity of the bank is lost. So the question is, isn't this related to the fact that failure was considered something that could never happen? Everyone was totally optimistic. They didn't consider diversification and simply invested. But then there's another aspect that we should add. First of all, you can see that the banks had major burdens as a result of these government bonds. But the other aspect, and that's the starting point for my consideration here, the fact that failure was not something that was even considered, the creditors remained the exception. The OECD took a look to see to what extent creditors were involved if a bank failed. In their study, the OECD said that there were only 4 countries, Denmark, Iceland, the UK, and the United States, where more than one bank where the creditors were involved. In all of the other cases, the creditors were rescued by the government bodies. In other words, the creditors did not have to take on the responsibility for the property that they held. In other words, with every step where the states rescued the creditor, then the risks for the states increased. So they were entering into more and more risks, and they entered a situation such as in Ireland and Spain, where state indebtedness went way up. So let me show you an example. You would expect, and in the ideal world, that creditors, to a major extent, whatever they would lose if a bank goes bankrupt, that they would lose this as well. But in Ireland, only 10% of the capital from the Irish banks was covered. Everything else was bailed out by the state itself. That's not a very good value, and this is a positive exception. In Spain, however, this process was much more difficult and it was much slower. So the creditors was much slower. So in other words, the failure was much less realistic for the creditors. So you could say, therefore, that one exception would be Cyprus, where there was participation by the creditors. This failure was also something that was taken into account, and that's my second point of criticism, and the fact that this leads to a great deal of insecurity for everyone involved, because you really didn't know what was going to happen. That's why it was revised. It took some time before they arrived at a solution. And this was a type of ad hoc application and no rules that will apply on a long-term basis and give us more security. So to conclude, here there are two major points. First of all, no involvement by the creditors, or you can't really call it involvement, and no clear-cut rules according to which the creditors are involved here. So that means that on the one hand, we have causality, which is due to the fact that banks are in trouble if they hold too many government bonds. But then again, we see this just the other way around as well. You can see the banks and the governments. If one has a problem, then the others will also have a problem as well. So there's a type of a vicious circle which will increase these risks even more. But let me come back to one point that's very important to me, and this reinforces it all once again. We're not only talking about the banks, and we're talking here about diversification, but you always have to spread your risks so that you can try to diversify your risks, spread your risks, but this is not the case if you consider the financial industry and take a closer look at it. You will find, for example, in Germany, that most of what banks invest are investments in securities that are issued from other banks. So that means in Germany, 80% of the investments by German banks are made in securities issued by other financial institutions. All sorts of creditor involvement would come to an end if you know that anybody who is to be involved or participate here is also an institution which has special protection. And this would mean systemic risks, which we could talk about in more detail as well. So that means that it can actually happen. In other words, participation by the creditors is not carried out because it would run a major risk that someone would be affected by this who would then want to be rescued himself. So this is the third party that plays a role here, a third case where diversification and buffers is not sufficiently present. Banks can cause countries problems and vice versa, and banks can cause other banks problems. So that means, in the final analysis, involvement by the creditors does not really exist. Failure has not been, or the possibility of failure is something that is not seen as realistic in the world in which we live, where we have such a high probability that there will be bailout methods or measures by the state, and this is something that would normally be done by the creditors in the private sector. So, in other words, we're faced with a situation which is threatening, and this we can't really tell how this can be improved in the long term. There are measures that are being considered on a European level to think about, for example, how the creditors can be more in a position to participate here. But these rules will not come into effect before 2018. So the question is, what will happen between now and 2018? There will be additional risks, and risks will have to be dealt with between now and then. These proposals are welcomed. Thinking in this direction is good, but we have not made sufficient progress for them to be applied yet, and they cannot be applied to follow clear-cut rules and clear-cut rules that will be abided by. And one thing is absolutely clear. This cannot happen overnight. Risks will have to be considered. But the basic question here is, can we have a system in the long term, especially a market economy, can we continue to apply bailouts by the states as opposed to a bail-in, for example, with the creditors? And my answer to all of this is no. So what do we need to do? My conclusion and the results that you can draw from all of this would be, firstly, that there is no clear-cut rule for all of this. There are many ad hoc measures that have been implemented, but there are no rules. And that's why it's very important for us to pass very clear-cut rules and to abide by these rules so that we don't have to begin from the beginning with every individual situation as to how to deal with a particular case. The next point is diversification. How can we ensure that the risks that we have, etc., certain areas will not be passed on to other areas. By diversification, we should then have, it should be easier to deal with the situation. And this is also related to the fact that we have to consider having more buffer, equity as a specific example, and in this way, damage that results could be kept within a specific institution without passing this on to additional institutions. And the final point, and that to me is the summary of all of this, is how can we manage to create a situation where we have neither explicit nor implicit guarantees that there will not be any failures. So you can say with a certain degree of probability that if you enter into risks, then these explicit or implicit state guarantees can be used, and then you will be able to avoid any losses. From all of this, I think that this is the major challenge which Europe and the euro area is faced with, and for banks in particular, but as far as the no bailout principle is concerned, also for the states themselves. In other words, the prices that we pay, and this would reflect the default risk, and we have to consider failure as a possibility, and where you might look to the state and ask the state to bail someone out if the calculations have not proved correct. So we have to establish the possibility of failure. This is a central issue. This will give us the best incentives to take a careful look and to consider carefully where you should invest. And this means that we will be transferring risks from the private to the state sector can then be prevented so that we will not continue to put this burden on the taxpayer as a result of the incorrect decisions that were taken in the private sector. Thank you very much.